Hello viewers, good morning. Welcome to this Investonomics series from ICICIdirect on the Union Budget 2023. We have a distinguished guest with us, Mr. Prateek Agrawal, Executive Director at Motilal Oswal AMC, to share his views on the Union Budget with us. Good morning, Prateek. Great to have you with us. We would like to have a first take on the budget. How would you rate the budget on a scale of 1 to 10, both on the capital markets and on the economy?
Now, budget does its weight. Budget was good in the circumstances. It was a frankly pleasant surprise, given that this was a last budget before elections, last full budget before elections. So I think the path to fiscal consolidation was not changed. There were no freebies extended. In fact, if you look at the subsidies have gone down. Some bit of it was announced even before the budget. Some bit of it, something like a Narega got announced in the budget. So very surprised, pleasantly so. I think the focus on capex continues, which is good for the long term. Now, there is some marginal reduction in tax for professionals, employed people. And since cities and smaller towns have more of the employed people in the organized sector, I think at the margin, it boosts consumption in smaller towns and cities by putting or leaving some more money in the hands of people. Rural probably did not need much. So if you look at the commentary of the FMCG companies which have delivered results, many of them spoke of rural, picking up. So urban probably needed some handholding, and I think whether that was the intention or not, in that terms, I think some better outlook for urban consumption. So capex 33% increase is the highlight of the budget. There, if you combine with CPSEs, where the expense is flat, I think it is 22%, which is still very good. If you look at from where the monies have come, it is through cut-in subsidies. It is through reduction in the food grain subsidy that got announced before the budget itself. And 1 lakh crore of extra deficit. So while the glide path has continued, but it still results in 1 lakh crore extra of deficit. So overall, I think I'm quite happy with the budget. I think key thing which could have made us happier is the convergence of taxation for unlisted equity, for example, and debt with that of equity. That did not happen because, frankly, these are not easy times, and I really thought we need to put our best foot forward for attracting global capital. Now, the IISc, allowing P-notes through Gift City is interesting. It will take time, but it is very interesting. So let us see. I would rate it very high, actually.
Okay. Do you feel any disappointments from the budget, if any? Though it seems a good budget, but
Yeah, so yeah, it is good, and we will see some changes along the way. So, for example, fertilizer subsidy has been reduced. Given the lower commodity prices, maybe this is realistic, but some of these numbers will change during the year. As of now, I think the numbers are very credible. So no disappointments there, except for the convergence of taxation. I really thought the longer time period of holding for unlisted and for debt could have brought down, converged to equity 1 year. That would have been good. That was a miss, but otherwise very good.
Okay. Much was expected on the infra front, and something was delivered. Are you satisfied, or some more was to be done in terms of the railway and the other infra?
No, very satisfied. See, the way it works is you are in the process of executing, you are in the process of planning, and it is basis the plan and execution. So, assuming there are 10 projects and those have to be executed from, let's say, 30% to 50% in a given year.
Mhm.
What the government would have to pay is what gets announced in the budget. It is not like, I want to do more capex and I can put in more money. That money needs to be spent. So,
Mhm.
same thing on defense, with all of the geopolitics going on, I hear people saying they're a tad disappointed with the 8.5% increase in defense capex. But boss, you
Mhm.
have to cite what you want to buy first. You already have plans which are rolled out. What the budget
Mhm.
does is key, for buying A, B, C, D, I will need to put in so much money, which is how it
Mhm.
happens. It is not like, I think of something and I want to buy, 20 more planes, five more submarines. It will take more than a year to scout for them. So
Mhm.
I think a lot of these happen. Most of the 1 year budget happens as per plan of whatever has already been committed. And
Mhm.
hence to say it could have been more, it could have been less is doing injustice to the whole process.
Okay. Okay. Uh, in your view, which sectors are going to gain basis the budget going forward?
So, capex benefits, it was already a theme that people were clued on. Already had tailwinds of, let's say, Europe plus one uh, uh, of railways. So, and the budget showcases that commitment. If we have to do so many more one-day trains in 2 years and then double of that quantity over the next 2 years, budget does provide for monies. Uh,
Mhm.
in the same manner, I think defense continues to be a very, very focus area. Capex spend in defense, I think the delta is higher than in the past. While 8.5
Okay.
may look small, but versus the trend line, it is larger. And with the indigenous content going up, I think the story continues. So from the budget, I would say these are the spaces to look at.
Okay. So there was a lot of talk. The finance minister spent some time on the new income tax regime, how she perceives it, and then some changes are also announced. So, what do you feel? How it is going to affect the consumption and investment both? Because in that investment does not have any uh, exemptions. So, how you feel how it's going to affect?
So it is still voluntary, right? Earlier, the
Yeah.
gap between new and the old was large. They have
Yeah.
sought to bridge it. They have made it better for the highest tax bracket to move to the new regime, which I think now
Hmm.
they will.
Okay.
But for the smaller guys, I think as yet the older regime makes sense, and they will continue. So once again, it is being nicely done. They introduce something, they share the intent. People did not move, so they have made it more attractive for one section of population. Now, next year, hopefully, they will make it more attractive for the next level of incomes and so on. So, I think let's not jump the gun. Government is going about it in a very measured manner, not causing
Hmm.
any heartburns there or hiccups there at all.
Okay. So, would it boost invest consumption in your view? Would the next going
Marginally,
forward the young?
if you look at the budget overall, it in terms of tax forgone. If you look at that number, it's a very small number, 33 odd thousand crores.
Yeah.
That in some ways the boost to consumption. Certain components for certain consumption items like TV, cell phone, the lower duty rates would apply for 1 more year. Is the other sort of support to consumption. I think the focus of the government is very clearly on building capacities, employing people, having more wage earners, and through that propelling consumption rather than giving out dose. So, if the plan to move, let's say, electronic manufacturing in India 3-4x over the next 2-3 years fructifies. Number of
Mhm.
people who gain employment there would be very large, and that has a
Mhm.
sustained multiplier effect. So that is
Okay.
something to be positive about. It is not one time. What they are trying to do is a more sustainable solution to our problems.
Okay. So, what's your view on the markets? The markets didn't behave in the right way, and what is the advice of the investors to where to allocate money going forward, keeping in mind the budget and
So,
how you
you know, uh,
foresee overall view?
So
Yeah.
budget is positive for the market. I mean, for market people, especially stock market, we did not hope to get what we got, especially given the pre-election year budget.
Yeah. Yeah.
Market levels themselves are good. Let me say that
Okay.
without any if and all of that. So my construct of the market is 18 to 18 and a half time 1 year forward earnings. So that 1 year forward earning today looks like to be between 950 and 1000, some number in between that. And the
Mhm.
swing is mostly on account of commodity. So that swing in profit doesn't change the outlook on the market much. So I had thought beginning of the year, and spoken about it in my communication to our investors that between Jan and March, if markets are between 18 and a half kind of numbers, that would be a fair level to end the year. We are close to that, but lower than that. Now, markets almost never move in sync. So today, maybe they are a tad lower than where at least I thought they should be. So going forward, I think versus the earnings growth, we should be expecting similar or a tad higher. That is what my construct of the market is. Now, the other thought that people have is of competing debt and equity. So
Mhm.
now, when markets were over 18,000, that definitely seemed to be the case. Debt looked way more attractive versus equity, a certain 8% versus an uncertain 12-13% on the index. Now, with the fall in the market, that equation also has changed materially, supported by some
Mhm.
dip already in the bond yields. Some dip
Mhm.
already in the bond yields. So I think, there is some valuation comfort in the market. Yes, FPIs have been moving some money away from India to China, kind of things, but those things settle down. One can never say how long it will take to settle down. But given the structural nature of flows in India, as our per capitas are moving up, people have risk-taking surpluses. I think the shallow dip that we have got is a good entry point. So,
Okay.
I make it simple and say SIPs are good, commit to the market in a structured manner, dips are better. Because we are
Okay.
Indians, we invest in India. Indian story is good and sustainable long period. So, dips are to be celebrated. And I think our young investor really celebrates that. Instead of getting
Okay.
spooked by the dip, being
Mhm.
confident in the longer term, I think people are using the dips to invest. And given the construct I shared, I think this dip is good enough to start investing.
So, where should they allocate money? Large caps, mid caps, or flexi? What is the final device on that?
Yeah, so that is a more difficult question. So it depends on the risk profile of an investor. I think the construct for the large cap part of the market is very solid. The
Hmm.
earnings momentum continues. Banks are a large part of larger cap indices, and that is the part that is leading earnings growth in 23 and will do well in 24 as well. 24 autos is the other part that will do well. Autos are going to see very strong earnings growth. Again, all of them are larger cap companies. So the construct for and if you look at structural flows into large cap, all the insurance money is large capish, all the EPFO money is large capish. So the construct for large cap is very solid. So if you are a lower risk taker, I think large cap is where you should be focused on. The other thing is, incrementally, if you take risk, okay, will it pay off is the question. If you move away from large cap, will it pay off? So there are chances that it pays off. And, I've been writing about it's a time to generate alpha. Now, what is happening? How does risk taking get rewarded? It will get rewarded one if the earnings breadth is strong. So it's not so much about quantum of earnings. It is more about breadth of earnings. Earnings are what people see, gain confidence from, and invest in the market. So
Yeah.
breadth of the earnings over last 2 years has been expanding. Don't go quarter by quarter, but otherwise it is expanding. So from COVID kind of a situation where large caps led the earnings growth, mid caps followed in 22 over 21. I think the journey continues, and with the budget and all the PLIs etc., I think it will get broader. So earnings are there, and second, I think alpha seeking money from youngsters into mutual funds, into PMSs directly on their own is also getting some amount of flow into that part of the market, while a volatile flow. Okay, so versus earlier, versus the period that we had from let's say 13 to a 20 kind of a period, 7-8 years, when either the high quality did well or the large caps did well. I think now chances of people who move away from the index into not so large cap, maybe larger mid cap, maybe mid cap space, is high. Now, lastly, how would earnings grow in 24 over 23? Banks, yes, but large part of it is margin increase. Now, margin increase is on the manufacturing side. Your input cost reduce. So, the value of that is not brands. So it is not that a FMCG company sees some benefit from manufacturing and we apply a 60 multiple to it. It is a manufacturing benefit that happens. It is not distribution or brand benefit. A manufacturing benefit, people who are largely deriving value from manufacturing are smaller mid caps or small caps. So I think there we should expect to see some bump up in profits as margins expand in the new year from what we have seen in quarter 2, and that should again give some amount of strength to that space. So you look at the drift of what I am saying. Larger caps less risky. As you move away from that, more risky. Okay, but still maybe now versus earlier, chances of making some alpha by drifting away is higher.
It was nice talking to you, Prateek, and a good insight which you gave to us on the markets as well as on the budget. Thanks for your time and sharing your time with us. Thank you, Prateek.
Thank you so much.
Thanks.
Bye.